Fed rate cut is here, and the reaction in the markets is nothing if not interesting. What does all this mean, and where do things go from here? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is unpack all of what just happened and try to make sense of where things are heading from here. There's certainly a lot to break down and a lot to consider, but the markets don't make it easy for us here today because what we end up with is not exactly the most convincing sort of price action one way or another. We end up instead with a sort of strange stasis ultimately, but the intraday price action does seem perhaps to be telling us at least how the markets read today's announcement and where it seems the overall story here is looking like it might develop, at least at first blush. So let's begin with that price action, and then we'll sort of back our way into what the makings of it might have been. So here's the S&P 500, and I think the most kind of glaring thing here immediately is it seems like we're looking at a market that wanted to go down and then didn't. So as we get the Fed news, we can see that things get a little bit soggy. The S&P dips down and then comes back and ultimately closes little changed. So a bit of a sense of maybe the markets didn't get exactly what they wanted, but also not exactly anything that the markets necessarily need to, at least seemingly, be concerned about. Then we look, and by the way, the NASDAQ looks about the same. We look at gold, and it's a similar sort of thing. Silver is a little bit heavier, but neither it nor gold ultimately break down beyond what was former sort of range top resistance. You can see it's now acting as support. This wick dips down. And again, same sort of readout. The market seemingly not all the way happy with this, but also not prepared to jump out the window on what the Fed is saying here, not willing to panic and get off its square. It's a little bit better sailing for the US dollar, and here the dollar is a little bit stronger. We're looking at the euro here as a sort of benchmark, and we can see here was the former swing high back in early July, and we end up tagging it and ultimately holding. So the dollar a little bit stronger than the signal we get, a little bit more convincing than what we saw in gold and what we see in stocks. Bonds ultimately don't go anywhere. They essentially remain locked within their range. Yields tick up just a bit, and they do it across the curve. The 30-year, the 10-year, the 2-year yields uniformly a little bit higher, but within the same range that we've been watching basically since the beginning of the month. So not really a strong signal one way or another, but the dollar does manage at the very least to head off what would have been a breakout earlier in the day with this extension above the high. And so the cumulative tone here, seemingly. Well, gold didn't love it. Stocks didn't love it. The dollar was a little bit higher. And altogether, the sense is that the markets wanted the Fed to be more dovish than this turned out to be. And now they must decide whether they don't like it in a lasting, more meaningful way. Because for now, it seems like the end of day is kind of a head scratcher, but the ultimate kind of positioning and the ultimate response is hardly panicky or bearish or anything of the sort. So why did the markets kind of shrug at this? Why did they find this to be not what they wanted to see? Well, looking at the summary of economic projections here, we can see that for all of the conversation about rate cuts and so on and so forth, what we find is the growth expectations uniformly here got nudged up for this year, next year, and the one that follows. The unemployment rate revised lower. Steady for this year, but what revisions there were lower. Inflation, mostly steady, but what revisions there were higher. And then we look at the outlook on rates. This is perhaps the most interesting part of this equation. Now, the median rate was 4.4 before today's cut. We can see in June, the Fed said for this year, we're going to be at 3.9, so that's two cuts from 4.4 to 4.1, and then down again to 3.9. So that gives you sort of a sense for where we are now, which is three cuts narrowly. Now, that seems like it's dovish, but the markets had most of those three cuts already discounted before this meeting. In fact, we can see here's the expectation for October. The day before the meeting, we can see we were somewhere around 70%, and now we're around somewhere like 82 for a cut. If we look at December, the third cut, again, somewhere around 68, 70%. Now we're at maybe 81 for a third cut. So we were, and this is the most important bit, it seems, on both of these, well over better than even odds, even a week ago. Never mind the day before the meeting. So another cut in October was, for the most part, already priced in. In fact, well priced in. Better than 50-50 by a long mile. And then a third cut, likewise. So if we then take a look at December, same thing. Well above 50-50 shot for a third cut even a week ago. And of course, yesterday. Now, there's been more conviction in all of this, but it's not like the Fed is telling the market something they weren't already looking at. Moreover, when you consider what got you to these three cuts here, let's take a look at the dot plot, and you can see here is the range of outcomes calling for two cuts or less. Here's the range calling for three cuts or more. And we can see that two cuts or less and three cuts here is an even split, 9 and 9. And then we have one lone dot that apparently is so aggressively dovish that it's looking to see a much more expansive rate cut cycle, even just this year. It's calling for rates not to come down to the 3.5 to 375 range, but to the 275 to 3 range. So almost a percentage point more dovish than what the markets have in mind, certainly in what other Fed officials have on the board. And so we very, very narrowly arrive at this third cut. And part of that is the median is skewed by this very out there dot. One can only surmise that's the dot for Stephen Myron, who the president just managed to squeeze onto the FOMC before this meeting. So not exactly the most dovish signal here, since the market's already had it discounted, and since the average is very clearly skewed by a single dot. The bigger story here is for next year, there's still only one cut. In June, it was from 3.9 to 3.6. Now it's from 3.6 to 3.4, but still just the one cut. And that, of course, clashes directly with what the markets have in mind. They still have 70 basis points on the board for next year. So that's at least two cuts with a strong 80-ish% chance of a third. And of course, the question continues to be, if there is this disconnect, if this is what we are looking at here, then are we going to have a situation where the stock market is going to have to turn lower in a disappointed fashion because this looks like it's more dovish than the Fed is now routinely endorsing? And do we have a bottom in the dollar here because we're not going to get more dovish on this outlook at this point, and so the dollar is basically out of reasons to fall? Looking at the comments from Fed Chair Powell here, we sort of get a sense for which direction we might be going. First, we get that there's a slowdown in economic activity. The Fed chair thinks this reflects mostly consumer spending. And of course, we've talked here on the show before extensively about the GDP numbers take on this in the first 6 months of the year. We, of course, don't have third quarter data yet, but for the first 6 months of the year, GDP numbers give us the weakest consumption in 5 years, with the reference point being the first 6 months of 2020, which, of course, is the COVID lockdown. That is an ominous comparison. We see that the justification for the cut here is that the balance of risks have shifted with downside risks to employment. Labor demand has softened, and job gains are running below the break-even rate. That's after that revision of annualized figures where rather than having an average clip of about 150,000 jobs added after the revisions, we looked more like half that for the preceding 12 months. And so indeed, it does look like we have a significant rethink there. Perhaps the most critical part of this equation is the Fed chair is saying, I am not blessing what the market is pricing in at all. There was no widespread support for a 50 basis point cut today. Makes sense in the context of expectations. And perhaps most importantly, you can think of this as a risk management cut. Now, what does this mean in the context of expectations? Well, if the expectations are calling for an expansive easing cycle, in particular next year, the Fed chair is very clearly saying that is not what we're endorsing. This is more like a maintenance move because the balance of risks seems to be shifting, where before we were mostly concerned about inflation and not really concerned about the labor market. Now we're a little bit more concerned about the labor market. You can see from this comment here, Fed Chair says, I don't think we can say that policy no longer warrants a restrictive policy setting. And with inflation at a 7-month high and in the vicinity of 3%, it's seemingly logical why that is. So if the story here seems to be that the market wanted something more dovish and is in fact baking in something more dovish, we can see it with the naked eye right here. And if what the Fed did with their expectations is undershoot that baseline, well, then one might reason that the path of least resistance for stocks is lower, the path of least resistance for the dollar is higher, and what we choose to think about bonds and gold probably depends on the interplay between the rates outlook and whatever risk premium is in the market around uncertainty, not the least of which around things like the Supreme Court's impending ruling, perhaps as soon as next month, about the legality of most of the Trump administration's tariffs. Lower courts have said that those tariffs, conditional on invoking national emergency grounds, are illegal. And now we're going to have to see what the Supreme Court says and whether they let the tariffs stand or they don't. But as we just spoke about on Overtime with Dylan Radigan momentarily before this show, a counter narrative and a logical one of that would be, okay, so the markets didn't get all the dovishness they wanted, hence this downswing, but they clearly recovered to be little changed into the end of the day. Ditto for gold. So is this really indicative of anything other than the market basically saying, right, this is not our ideal scenario, but ultimately this is fine? And marking resilience in the rally for gold, resilience in the rally for stocks, and we'll see what this means for the dollar, but the dollar maybe still has room to bottom. But again, this is not certainly a running away of dollar momentum, certainly not relative to this breakout out of this congestion range in the euro. One might think you would at least need to get back in here somewhere to make the case that the dollar is getting ready to run in earnest, at least from a technical or a price action kind of a perspective. So how this all filters through these markets over the next 24 hours should be very interesting indeed. And in the meantime, we are looking at a little bit more event risk overnight. The Bank of England is due to issue its policy announcement. The expectation is we're going to remain at 4% this time around. Rates are going to hold unchanged. But the really big question for the Bank of England and indeed for markets is going to be what the voting pattern here is going to look like. Because as it stands, the expectation is there's going to be fairly good conviction. 7 out of 9 policymakers on the MPC, the Monetary Policy Committee, voting for a hold, and 2 out of 9 voting for a cut. But it was really, really finely balanced in the previous decision. 4-9 for a hold, 5-9 for a cut. And that's largely around inflation in the UK looking more chipper recently. The numbers that we just got over the past 24 hours on inflation in the UK confirm expectations, 3.8% as expected and unchanged from the prior month. But that is, nevertheless, a repeat of what is or of what was in July at 3.8%, the highest in over a year, going back to January 2024. The last time that we were that high on UK inflation. Core inflation came down, again, as expected, from 3.8 to 3.6%, so nothing really to see there. But obviously, inflation is closer to 4 than it is to 3, and so much hotter than the Bank of England wants it. And so it'll be interesting to see how this calculus breaks out and what it ultimately means for the British pound, which held up a little bit better than the euro today. Positioning wise, and from that perspective, I am going into this a little bit long the pound, a little bit short the euro. Still have my short put position and so long side in gold, my long calls spread in silver, so I'm still long the metals, and a little bit short in stocks. I've got a put spread in SPY, so keeping it small, keeping it risk defined, and straddling both sides of the fence. I am both long and short the dollar. I am both long the metals and short stocks. So I'm looking to see how this resolves into the end of tomorrow's session, and then I'll probably make some decisions on which side of the equation here to pick, and either the risk on or the risk off side, either the dovish or the hawkish Fed implication side, and we'll see how it goes. But as it stands, at least, the markets did not get out of the Fed everything they wanted, and the price action today speaks as much accordingly. And that's macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I am also commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.